Owning gold and silver can be a great way to protect your wealth from inflation. The only drawback is that your metal just sits there collecting dust or racking up storage fees. If you started with 100 ounces, you may end up with only 95 ounces 10 years later. But what if your gold and silver could do more? What if you could grow your ounces just like you grow your other investments? Now you can with Monetary Metals. Monetary Metals' innovative platform connects gold owners and businesses to provide clients with a yield of their gold and silver paid back in ounces of physical metals. You can earn up to 5% in the precious metals program, and if you're an accredited investor, you can earn 12% on your silver right now in the latest bond offering. All the interest is paid back in physical ounces of gold and silver directly to your account, so your total ounces grow and compound year over year. Go to realvision.com/metals to learn more about how you can make your metals work for you today.
You're listening to Macro Mondays, hosted by Andreas Steno.
Hello out there. Welcome to another edition of Macro Mondays, on top of a week, of course, marked by the 50 basis point cut from the Fed. My name is Mikkel Rosenvold. I'm your host, and I'm, as usual, joined by Andreas Steno to talk about the rate cut, what lies ahead, and what data we can actually trust in trying to predict future movements of the Fed. Of course, we're also looking into how to position on top of this cut and a little bit of window dressing at the end of this show. Welcome, Andreas. How's things at your end?
All good, Mikkel. I'm trying to lean back a little bit here. I think the macro picture is brightening up ahead of the fourth quarter, which is obviously good news for those of you listening to this show, at least if you're invested. So I'm starting to sound a little bit more upbeat, and that was exactly what we hoped for a couple of weeks ago. So all good.
Absolutely, Andreas. As mentioned in this episode, we're looking at a little bit of the data behind the upcoming Fed decisions. We're looking at some of the risks at the moment. We have a debt ceiling cut coming out. We have a situation evolving in Lebanon, and then, of course, talking a little bit about positioning, Andreas. But let's start at looking a little bit in the rearview mirror at the rate cut, which dominated markets last week. Not so much NVIDIA anymore, but more about the cuts. These were the 50 basis points cut that you more or less predicted last week. Did anything in market reactions or the announcement from the Fed surprise you, Andreas?
So I guess the key question, Mikkel, ahead of this decision was to ask yourself whether 50 basis points is something positive or negative. For example, the block zero hedge, they kept posting both blogs and tweets around 50 basis points being bad for the market. And then in response to that, I tweeted, tell me, as if I'm a golden retriever, why 50 basis points is worse than 25 basis points. I don't get it. It doesn't make any logical sense. And I guess the response I got from the crowd out there, and even probably from some of the authors of Zero Hedge, was that, well, there's kind of a panicky signal about doing 50 instead of 25. And we have a couple of cutting cycles that commenced with 50 basis points to look at. Obviously, 2007 and 2001 as a few examples. So is it ultimately bad news that the Fed delivers 50? Well, if you look at it very simply speaking and base it on almost on the anecdotal evidence from earlier cutting cycles, yes, it could be bad news, but there's nothing fundamental about that analysis, right? The reason why 50 basis points could be bad for the economy is that the economy is doing bad, right? They don't do 50 to harm the economy. They do 50 to try and solve the economy, right? That's the way things turn, right? So if you look at it empirically and look at the cutting cycles and, for example, NASDAQ or other risk assets around the start of the cutting cycle, it's typically okay news. It's not necessarily the point in the cycle where we have the tremendous returns just ahead of us. But if you look at NASDAQ, for example, around the first cut, as we have on the screens here, you have for a 4 out of 5 hit ratio over the past cutting cycles of being long over the coming 2 months.
Yeah, with 2001 obviously being a heavy outlier, the dot-com bubble back then, it's a story of its own, essentially.
Yeah, essentially, yes. And I mean, I guess they could have done more or less anything, and nothing would have worked at the time, right, to solve that dot-com bubble. So, case in point here, Mikkel, 50 basis points is good news unless the economy falls apart, and we don't have evidence of the economy falling apart. So I'll lean towards 50 basis points being good news for now.
So it seems like, Andreas, that the Fed has now unequivocally moved away from combating inflation to combating unemployment, so to speak, focusing their efforts on the U.S. job market. The question is, Andreas, can we trust this hiring data? I know you've had a look at this. We're going to go through some charts. This one is going around social media a lot. That employment is doing really well because everyone is getting second and third jobs. I know that's layered into most statistics, but it's a fun one nonetheless.
Yes. So Mikkel, the first thing I tell our analysts and junior PMs when they get into our office is that if you cannot show it in a meme, then it's not true. No. I prefer memes to charts because this is extremely telling, because there's actually some merit to this meme. We've seen a clear increase in second jobs. We've seen a clear increase in part-time employment, typically due to it being a second job, right? While the full-time employment is actually fading. And why is that? Well, I mean, I don't think it's out of the ordinary to explain this with the inflation crisis that we've been through. If you struggle with delinquencies, or if you struggle to pay the bills for necessities, you're simply forced into taking another job, right, to try and cover your expenses. And I think that's quite frankly what is happening here with the time lag. So this is linked to what we've been through. And in other parts of the world, it would have been extremely out of the ordinary to see this, but the US labor market is extremely dynamic and flexible. So this is just what happens when there's an inflation crisis. But can we trust the data? I mean, we had that presidential debate a few weeks ago, and Trump mentioned the big cover up in non-farm payrolls data and the massive adjustment or the massive revision to that data. Was it a month ago or so? We obviously had a revision of around 800K jobs over the past year, which is a lot. And typically when we've seen such revisions, it's because the labor market is in some sort of recession, right? There's a big if this time around, and that is linked to the immigration we've seen over the past 24 months in the US. So the way that the non-farm payrolls data is collected on a monthly basis is via a survey, basically. So it's not the full sample of the US economy. So if you look at it in practical terms, you simply survey people who own a business or people who employ by employers and ask them whether they've hired or laid off people during the month. And in such a survey, you can actually say, yes, we've hired 5 illegal aliens. You probably wouldn't state that those 5 are illegal immigrants, but you've hired 5 people. It's an anonymous survey, at least the results of them. So, I mean, it's not really a risk to run. The data that they use to revise the non-farm payrolls data is based on insurance data. And if you, Mikkel, were to employ an illegal alien coming from Nicaragua or whatever, you probably wouldn't decide to insure that person straight out of gates, right? No. So I think there's a part of the gap that we see between the running non-farm payrolls data and the revised non-farm payrolls data is driven by the lack of the sort of ability of the statistical authorities to truly measure the employment among immigrants.
Yeah. So there's a lot of static in these data, and
Yeah.
that could lead the Fed to suboptimal decisions. There's some seasonality as well, which is quite interesting, Andreas, that we usually see weaker hiring data in the first half of election years. This should point to hiring data improving for the latter part of 2024, or how should we view this?
Yeah, so we've basically taken employment data all the way back to 1940 here. So we're approaching 100 years of data. And it's a very strong pattern across election years that we see a lot of uncertainty related to hiring ahead of the election. Meaning that the gap between election years and non-election years typically narrows after the election. So especially in November and December, as you can see from the chart here.
So people are simply holding off on hiring because of the uncertainty of the election, perhaps?
Yeah, it could be as simple as that, yes. Mikkel, we are used to running businesses in the northern parts of Europe where the election certainty and the political landscape is extremely stable. We basically know what to expect no matter who wins. It will be a social welfare state, no big changes to foreign policy, no matter who wins, right? That's not the case in the US this time around. We had a lot of feedback on us discussing US politics last week. So I'll refrain from picking a side here. That's kind of not the point here. The point is there is a major gap between the two sides. I think that's safe to say, right?
Absolutely.
And it will matter a lot for economic policy and for foreign policy, whether it's Mrs. Harris or Mr. Trump running for office, right? And therefore, I kind of get why you would hold back with hiring, given this outcome space. I mean, you basically don't know what to expect. Maybe you know the outcome space, but it's a very wide one, right? You would prefer a narrow one if you were to take decisions right now.
Yeah. Especially also government hiring could also be affected by this. So,
absolutely.
So very interesting point. Yeah. Of course, the Fed will know a lot of these things, but it's very interesting looking ahead at what the Fed might do.
But one point to add here is that, as you can see from the chart we share on the screen now, 2024 has been worse than typical election years. Not by a lot, but still worse. So maybe there is something more to it than just the election uncertainty. But if you look at the beige book, the one that is collected by the Fed occasionally, you'll also see that a lot of the employers that they ask for qualitative feedback, they say that they're currently only replacing key jobs while they are awaiting the election to increase hiring again. So I think it's a very feasible thesis.
Very interesting, Andreas. And so just to round off this part about the cutting cycle, we'll get back to the positioning of course of this, but Andreas, what do you expect for the rest of the year? Two further cuts locked in, or any surprises in store?
Yeah, so Mikkel, I'd like to show another chart, the next one we have with us on withheld taxes versus jobs. So I'm of the view that even though job data is tricky to sort of rubber stamp, if that's a word for now. I mean, it's tricky to figure out whether hiring is strong or not, given the weaknesses in data that we've just discussed. But you can actually, with a quite high precision, figure out whether the job market is improving or not by looking at taxes, right? Because if you look at withheld taxes on an individual basis, I mean, you obviously need a job to create a withheld tax in the time series from the Treasury.
You would hope so.
It basically measures the taxes withheld because of employment, right? And when you look at withheld taxes year over year, so basically since a year ago, we're up just a little less than 5%, meaning that job growth is positive. I mean, you cannot have a 5% increase in withheld taxes with negative employment growth unless you have a bizarre increase in wages. And we don't have that bizarre increase in wages right now. We're probably running, say, between 3 and 4%. So I think the annual growth in employment is around 1 to 2%. That range is the feasible outcome. which is, by the way, weaker than what is stated in the non-farm payroll still. So I think it is fair to cut interest rates given what we see in the labor market, and all of the uncertainty surrounding how to collect the data basically postponed this decision for a bit too long. But now they're front-loading the decision because they know, or they have the vibe that they're a little late now. So the 2 cuts that they've penciled in for the rest of the year, we don't need major surprises on the unemployment front to bring that up to 50 basis points per meeting again. Remember that, was it 1 week ahead of this meeting last week, no one dared to call for a 50. And all of a sudden it was basically the base case of right about everyone. So that could easily happen again in October and December.
Absolutely. So Andreas, obviously once we get to our positioning strategy around this, we're going to be talking fixed income. One of the risk areas we're just going to be covering, or 2 risk areas, is one, the debt ceiling, the upcoming appropriations debate in the U.S. Congress, as well as the potential for war in Lebanon. Let's begin in the U.S. with approaching debt ceiling. I like this meme. I don't know if this is a chart or a meme anyway. Where they're going to flatten this curve. Obviously, the debt ceiling is meant to flatten this curve, but not really working, is it? So obviously we're looking into the federal fiscal year ending, and legislators are as usual, you might say, caught in a deadlock. Many Republicans, including Trump, are linking this to voting rights, to whether non-citizens should be banned from voting, how harshly that should be done. So we are really a political deadlock on this. We can maybe talk more about this next week, but the risk factor for various assets.
It's an extraordinary chart, right? First of all,
it is.
But I don't know what you're. Are you suggesting to bring Anthony Fauci in charge of the U.S. Treasury or what? But I don't know how to read this. But the point here is, Mikkel, that I don't really see either side of the aisle trying to combat this right now. I think that's one of the reasons why I've been wrong-footed in gold. This chart is just to the moon. So obviously you need something hard to hedge against this. I also think that's why we've seen crypto performing, right? It's as simple as that.
Yeah. You want to unfuck your shit? This
is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
Yeah, absolutely. So, in my view, at least, looking from the outside into the US, the only solutions I see being floated for this is lower rates and higher inflation. That's, of course, always a very good combination when you have a lot of debt. But whether it's sustainable, that's another question. You brought along this chart, Andreas, on the U.S. Treasury cash balance reserve account. What does it tell you that the balance is so much higher than 2 previous debt ceiling scares?
Well, I don't necessarily think that's out of the ordinary. What's a bit out of the ordinary is that they haven't started the descent towards zero ahead of the ultimate debt ceiling deadline, 1st of Jan next year. So by design, the U.S. Treasury is not allowed to hold a lot of idle cash ahead of the ultimate deadline. As you mentioned, Mikkel, we have these negotiations around, is it called appropriations in Congress right now? But if we get a meltdown in those negotiations, we'll probably get a shutdown of the govy. But it doesn't necessarily mean that anything will happen in terms of market reactions. I don't think a lot will happen. But what will happen is that the U.S. Treasury will have to issue less bonds. Because if they know that the debt ceiling is around the corner, they'll have to bring their cash holdings down, which is what we see on the chart here. And when the U.S. Treasury holds fewer dollars, commercial banks will be on the receiving end of those dollars. So you should expect very low issuance during the 4th quarter. You should expect a massive positive liquidity trend from this withdrawal of cash from the TGA, as it is abbreviated. And that's basically good news. no bonds to buy, meaning that there will probably be a bidding war for the ones remaining. No bonds to buy that was kind of an exaggeration, but you know what I mean. And then liquidity added to commercial banks and private markets, which is typically positive for risk assets. So we've been waiting for some sort of positive signaling from liquidity, and I think we'll get it big time during the fourth quarter.
Very, very interesting, Andreas.
So as you can see, maybe I can add a few words on this chart, Mikkel, because we had a look at how treasuries perform before and after a debt ceiling deal. So look at it this way. Ahead of the deal, the US Treasury will have to spend the cash that they hold idle instead of issuing. While after the deal is struck, they'll start issuing a lot of bonds again, because they'll both have to fund the operations of the US and they'll have to rebuild the war chest of the TGA, meaning that we have a double whammy in issuance. And as you can see from the chart here, you can buy treasuries ahead of that deadline. Don't hold them after the deadline. It's kind of the same for risk assets, by the way.
Absolutely, and this feeds into also what we've been discussing on performance of US Treasuries after the first rate cut. One of the only asset classes with a more or less complete hit ratio after the initiation of a new cutting season. So a whole lot of history, at least, pointing in that direction. A lot of fundamentals as well, probably. I just want to touch upon.
I agree with this chart. I mean, it's very hard to argue against the 100% hit ratio, right?
Yeah. It's very few data points, though. Obviously, I mean, we don't have that many cutting seasons.
But you could obviously look even further back, and it would have been more or less the same conclusion. But interestingly, it didn't really work from Wednesday to Friday,
Nope.
and not from the beginning of the week either. As a here, so I mean, we're in all transparency, we're long a few inflation protected treasuries, and well, I mean, it was okay in the run up to this 50 basis point cut, but it hasn't really been a strong case since. So,
no. Andreas, just a quick detour before we get to positioning. We've been getting a lot of questions on the situation in the Middle East, as always. Is there a potential for war in Lebanon? Essentially, what we saw last week was obviously the now very, very famous pager attacks, the walkie-talkie attacks on Hezbollah operatives inside Lebanon. What was very clear at that point, we discussed that with a lot of clients as well, was that in my view, this had to be the precursor to a larger attack. Otherwise, you wouldn't use this trump card. Obviously, they're doing this to create chaos and then move in with larger attacks. Over the weekend of last week, we saw more or less the second phase of this operation, as far as I see it, and I expect this week to include more ground operations. Is this a full-on war? Is this the grand regional war that everyone is scared of? No. This is action against Hezbollah. This has happened before. This doesn't mean that Israel is going into a state of war with the state of Lebanon. This is only the group of Hezbollah who covers or who controls a lot of the south of that country. And it doesn't mean an all-out war between Israel and Iran. We will most likely see an exchange of missiles in very, very heated scenario over the coming 1 to 2 to 3 weeks. So it is obviously a risk factor for markets and something you should be watching. But for now, it seems that markets was, as we had the meme before, much more interested in cuts than Lebanon. One final note here, just to put some analysis to this. I'm still of the belief that this is very much driven by the desire of Prime Minister Netanyahu to keep his political career alive. Essentially, the debacle of October 7th, the now year-long war in Gaza, has been quite an embarrassment for Netanyahu. That's the bottom line of it. And a successful campaign against Hezbollah in Lebanon could prove very, very effective in securing his political future, essentially. So that's also part of this equation. Obviously, domestic policies are always a very big part of these scenarios. But just a risk factor to keep in mind over the coming week. If we see huge escalations between Iran and Israel, this could cause some disruptions, and for the short-term traders, something to keep in mind, perhaps take advantage of. You can, of course, follow our coverage on this on stenoresearch.com. Follow me on Twitter, and you as well, Andreas, for more on that. But just a little detour there, Andreas. Let's get to the positioning in some of our data models here. We obviously cover on a daily basis now our macro regime models in various geographies, US, of course, most notably. So I like to bring these into the show once in a while. Andreas, we're still in low territory for all three of our main macro indicators, with some rising tendencies in both growth and inflation for the US. What to look out for in the US macro regime right now?
So liquidity is currently tight due to, first of all, the tax season and due to September window dressing. We'll get back to the window dressing by banks and funds towards the end of the show. But as you can see from the green line, very low probability of rising liquidity spot. I mean, right now, the probability is low. I think it will change into the fourth quarter, as I mentioned. Growth probabilities mixed, but to the weak side, and inflation probabilities also low, but increasing slightly now, which is, I guess, something worth watching if the trend continues. I still think this cocktail is positive for fixed income for now, and positive for things that are sensitive to a soft Fed, if you know what I mean. So the dollar has been weak because of this as well, right? Also against, for example, precious metals, which wrong-footed us, but also against the currencies elsewhere. So dollar weakness, strong fixed income markets. I still think that's the case for the remainder of the month. And then, fingers crossed, we'll start to see a much more benign scenario during the fourth quarter. But the point of this regime model, the point of our daily probability gauging, is to control our returns on a daily basis. So this basically ensures that we do not get nasty drawdowns. So we get returns, but we have a very strong control of our tail risk because of this gauging of risks on a daily basis.
Absolutely interesting. Just to give them a sneak peek, we also do these macro regime models on the Eurozone. Not too dissimilar from the US situation, with not quite as bleak a picture on liquidity, but still very, very low trends on inflation and possibly in growth. We do this in China as well. Our nowcasting models has depicted throughout the month of September very, very sharp drop-off in the probability of rising liquidity. So we're doing these models on several geographies to essentially cover the potential asset classes and making investment decisions. I just wanted to show this as well, Andreas. We've talked a lot about fixed income. This is some of our. This comes from our fair value model, which tries to identify fair value gaps within various asset classes. This is the fixed income here. How do you, just to give the listeners a sneak peek into your daily geometers, when you get this report each morning, how do you digest this? How do you work from this?
So maybe if you can show the data on the macro regimes again from the page prior to this, just to allow our audience also to get that input. So when we run these regime models daily, our Python setup basically spits out the assets that return the best adjusted for volatility in these environments. And as you can see, the top assets are almost all in fixed income space and related bets, for example, in real estate equities. I'm long both in full transparency because our model has told us to be. And it's been a very, very solid trend model over the past months with strong performance in fixed income and strong performance in real estate related assets. And as you can see, the worst performing assets, the dollar versus the Singapore dollar, it's been one-way traffic, and our model has basically told us that it would happen. Dollar versus yen. I think that's very interesting right now with the dollar versus yen being repriced a bit higher towards the end of last week. So that's the trend. When the trend turns, and we may be the verge of a trend turn towards Q4, we'll use what we see on the next page, namely the fair values, to try and assess where we're headed next. And as you can see, some of the trends that have been extremely strong through this quarter, for example, the 210 steepener in the US swap curve, it is now a couple of standard deviations above where it's predicted to be when the dust settles. So the point here is that we track trends on a daily basis to be able to gather those turning points. When those turning points show up, we'll be guided by this fair value to see where things will ultimately settle. So we are extremely structured around this. We're short term in full transparency, and you can basically get a daily input from this data on stenoresearch.com if you sign up.
Absolutely. So just a small disclaimer, as you mentioned, Andreas, this is obviously meant for very, very short-term tactical trading.
Yes.
This more or less requires you to do this on a daily basis. We do that, so you can follow our thinking on this. But of course, always evaluate your own risk and perform your own due diligence on this. Yeah. But this is just an attempt to give a look into how we view things and how we structure the analysis and recommendations and ideas that we post both on stenoresearch.com and obviously in this show as well. Great stuff, Andreas. Let's just get to the window dressing. I know that's a very, very big issue for you to explain this. And I think it's important if you're looking out there as a macro observer, looking at some of the liquidity data over the coming weeks. This is a very, very interesting piece of backdrop to understand that. So what do you mean by window dressing?
So I've spent most of my career in banks, and banks window dress a lot because of regulation, basically. So look at it this way. By the end of each quarter, and ultimately come year end, you'll have a data print like the 31st of December, month end September, etc. Those exact daily balances is what you report to financial authorities, meaning that you're trying to cover up your balance sheet by quarter end and by year end to avoid all sorts of extra payments due to balance sheet sizes, leverage, whatever. That's the simple way of understanding it. So take the example of leverage by year end. You want to showcase a year-end balance that is as unlevered as possible as a bank, because that's the data point that the authorities will mostly look at. You want to show a data point with as few deposits as possible, basically, because that's the data point that they'll use to calculate your payments to the Federal Deposit Insurance Corporation. So the more deposits you have, the more you have to pay for the insurance next year, right? So everyone's trying to window dress, trying to make it seem like they have a smaller balance sheet than they actually have. And that's very negative for risk, because, I mean, every single bank on earth and their treasury departments, they're running towards the same door at the same time, because it's expensive to do this window dressing for days. So you'll do it, say 5 minutes to midnight, right? And that is essentially what will happen on Friday, and then on the following Monday. And I think it's one of the reasons why we typically see a very bad performance in September, because by quarter end September, the year end is rolling beneath the 3-month window, which is typically what the window you kind of use to hedge against these things. And that's also what you see in cross-currency markets on the next page, Mikkel, that every single quarter end in September, we see a nasty drawdown in the cross-currency basis. And for those of you who are not familiar with the cross-currency basis, you could argue that this is the price of obtaining dollar liquidity from abroad, right? So this, in this example, is the euro-dollar cross-currency basis, moved from, between friends, 10 basis points to minus 75 basis points in September 22. It moved from 10 basis points to minus 40 or so in September 23. And what will happen in September 24? Well, I guess the best guess is around minus 60 because the liquidity is tighter than it was in 23 and it's more ample than it was in 22. So somewhere in between is probably the best guess here. And why is that important? Well, it shows that there's a quote unquote dash for dollar cash in money markets by quarter end of September. And it's just something that typically spills over a little bit to other assets. If you look at the seasonal returns in equities between now and month end, worst possible days during the calendar year to hold risk. It's empirically correct, but there is also some fundamental merit to it. It's because all banks are chasing the same goal. And it will happen again this year. It will happen again next year. And will happen again in 2026 and 2027 until the regulators come up with a smart solution to this. This is all driven by regulators. They're basically incentivizing banks to do it.
So do a sell-off. Take a 1 week vacation, perhaps over the end of September here.
Yeah.
Very actionable, very direct advice here.
I mean, in all honesty, we're still in fixed income, and we kind of dislike going into a lot of risk towards month end here. And we also consider commodity markets to be vulnerable to this story. Maybe the dollar will get a bit of tailwind from this. And then when we're on the other side of this into October, it's time to pull out the leverage and hope for the banana zone. I think that's quite frankly what will happen here.
Makes a lot of sense, Andreas. Great stuff. I think that was very actionable, very to the point here. I don't have anything else. You have any last words, Andreas, before we round off the show?
Yeah, I mean, Mikkel, final thing I wanted to ask you about. So this is the key topic in finance this week. How do we know when or if to trigger the sell button in the Middle East? I mean, is there something like concrete to watch?
Yeah. Of course, people like me are going to be watching the movement of tanks, the movement of troops. What we need to see is if there is a window for some sort of negotiations. I don't mean a major peace deal, but if there is a window where the Israelis can be pressured to hold off ground operations, because ground operations is going to be the nasty part of this. We've seen aerial bombardments towards the end of last week. That didn't affect markets too much. Ground operations are going to truly, and especially reactions from Iran are going to truly. So once you see news of a ground operations, that means that if Israel hasn't been dissuaded to go this path, and that will most likely trigger a response from Iran, which could be over interpreted in across investors' space. So look for the tanks to crossing the border. That's the very simple answer here. Looks for movements on the ground, because that's what might trigger more widespread reactions throughout the region.
Fair point.
Great stuff. I think that's all we have for this week. Tune in again next week. We'll do a lot more on our data models, give an update on what has hopefully not been as bloody a week in Lebanon as I'm predicting here. And just looking forward to another great week in macro. Thanks a lot for joining, Andreas.
Thank you, Mikkel. Good to see you.
Yeah. And thanks a lot for watching. We'll see you next week.
Owning gold and silver can be a great way to protect your wealth from inflation. The only drawback is that your metal just sits there collecting dust or racking up storage fees. If you started with 100 ounces, you may end up with only 95 ounces 10 years later. But what if your gold and silver could do more? What if you could grow your ounces just like you grow your other investments? Now you can with Monetary Metals. Monetary Metals' innovative platform connects gold owners and businesses to provide clients with a yield of their gold and silver paid back in ounces of physical metals. You can earn up to 5% in the precious metals program, and if you're an accredited investor, you can earn 12% on your silver right now in the latest bond offering. All the interest is paid back in physical ounces of gold and silver directly to your account, so your total ounces grow and compound year over year. Go to realvision.com/metals to learn more about how you can make your metals work for you today.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.